Hi, here we are, finally. This is our first presentation live, and as you know, we've been talking about FUBO. FUBO is a company which is very interesting, actually, and we actually we've been long since $1950, and now it's currently what we're speaking is 27.10. I think even more. In the last few minutes, it went up. Even more. So we are here with Eddie, they help us with the presentation, and with Santiago. Eddie is a analyst, and Santiago is a man with a lot of experience. He works for in investment banking for many firms, from Goldman Sachs to Societe Generale and other banks. And that's me here now, that trying to sort of like being the host of this presentation. So I like FUBO, and we're gonna explain. Eddie's gonna start speaking now about what is FUBO and what kind of business that is FUBO involved in, and then I'm gonna talk about why it's important to look at subscription company in a different way. So there's different approach to valuation, but subscription companies are particular. They have a certain kind of way they should be actually assessed. And we're gonna go through that, and then Santiago is gonna help us he's gonna go through a model and show us how did he come up with a valuation. Then we're gonna have a chat, the three of us, about what should be the approach, and what could be the value, the fair value price for FUBO, and what could be the risk involved with investing in FUBO. Let's move on then, without further ado. Eddie.
Okay. Hi guys. Well, we have been looking at FUBO for some time now, as Antonio said, and FUBO, for you, those of you who doesn't know yet, FUBO is a streaming platform focused primarily on live sports. It's a cable coding alternatives. So it's been growing. This kind of companies have been growing for the last few years, and FUBO is made especially for those who watch various sports channels and don't like to miss any games. They have been having problems with NFL and NBA, but they already got them too. So you can watch it on Chromecast, Amazon Fire, Roku, Xbox, and so on. Most people look it through the internet, through Google Chrome and Internet Explorers. So the basic plan starts in about $60, and then you can add extras. So it works mostly like a cable provider. And then you have the other plans, the family plan, and the one with Showtime. On the right side, you can see the interface, how it looks like. So like DirecTV or something like that. You got ads here, and the price, the final price, the ultra plan is $85, so cheaper than any cable provider. And the market, the average cost of the cable bill in the US is about $100 per house. So when you compare this with $60, $40, you can save a lot of money, and you can watch all the channels that you want. So the traditional way of delivering television content is being disrupted by the streaming platforms, as you know. And these guys have pretty well a platform, and they have many opportunities to grow. There you have similar services. So YouTube TV is one of the competitions. It has, from the top 100 channels, they got 76. Then you got FUBO, Hulu, AT&T, ILO, Singlu, and so on. So those that are focused on sports, and there are actually pretty strong competition, are Dance and ESPN Plus, that cost about $20 and $6. But they are focused on sports, only sports. So you got the opportunities of FUBO are basically two: improve and increase the advertising revenue revenue and also getting into the betting market. There is an excellent opportunity. DraftKings is a good example of that. So for the financial overview and some insights, they have been growing since, very well since the pandemic started. So for this last quarter, they reached a peak on paid subscribers, 455,000 subscribers, and it's it's really well. Their subscription base has been growing too, as you can see here, and the advertising is increasingly dramatically, so 153% just the last quarter. Then you go then you got the average revenue per user. This is monthly, so they have been able to keep growing even though they have increased the price. It's a it's a pretty well insight. So people find it better than others, or they don't have other place to move, because it's really easy to change from platform to platform, and they keep raising the price, and people stay, and they keep getting new people into. These have been growing too. These numbers have been growing for the last 2 years. And the total content hours is something to get in mind, because this is extremely correlated to the advertising. So it's a pretty good insight too.
So basically, if you let me add in, one of the things that we need to remember before we go actually into how we evaluate is that FUBO did a merger, right? Did a merger with with a company.
Yeah.
Yeah, amazing. And the company was called FaceBank, right? And what is FaceBank, Eddie? Can you tell us?
Yeah, FaceBank is basically a technology-driven platform. So they mostly do IP in sports, movies, and also live shows, and they are an e-commerce payment service platform. So this merge is absolutely amazing for FUBO, because they can integrate payments into their platform, turning it into.
This is important, because there is one thing that people do not understand with disruptive company. Okay, disruptive company at the beginning of the cycle of when they initiate their business, then they need to high-tech company to grow. They need to spend money, to burn money. Okay, some of the money they need to burn is part of their life cycle. I mean, in that kind of at this kind of stage is when they mostly likely you cannot assess a company based on how much money they make. That's why value investing fail in actually spotting those kind of company, which actually they can have an enormous growth, and they can actually increase. They can become a multi-baggers. Okay, and if you look at other things, there is one thing that value investing actually miss to spot is the things that most of those companies, due to GAAP accounting, okay, cannot capitalize their money spent in intangibles. This is an example. If you look at, you have as operating expenses, the last quarter, you have a 236 million, which is basically going to be impaired. In this case, it looks like totally, okay? So they're gonna come off as a cost, looking like they're burning money, but what it is just an impairment, probably based on the valuation of the FaceBank merger, and that that's normal for a company which is growing for a growth company, for a disruptive company, for a technology company to actually have a lot of intangibles that are not kept, they're not kept they're not seen in the GIP accounting, because they just go directly to the operating expenses, and they get burned out as a cost, while a careful investor should be able to assess them to capitalize them, in order to have an assessment of the high-tech company from when you're looking at the balance sheets, and this is one of the things. And another thing is so Circle, usually we need to be careful to the metrics they use to assess those companies. Okay, to be careful because usually the ratio of price to sales. If you look at Roku, for example, Roku has a price to sales of this moment probably is 15, 16 or something around that number, and you look at FUBO, which is barely 4.5, at the moment. So you think, okay, there could be a multiple expansion which could help us to increase the value of the company. But in order to do that, you need to assess why there is such a gap between the price sales valuation of Roku and FUBO. And probably is because Roku is a different model. Roku, is not in direct competition with any other things, because Roku is an advertising business that can actually go along with all the others. So their model is totally different. And also, things that you need to understand. To understand how to value those companies, you need to get familiar with some concepts. And every asset is always been, the sum of the cash flow discounted by the other rate. So to be able to look at the cash flow produced by a subsidiary company, you need to look at a concept which is called customer lifetime. Customer lifetime is the value of the subscriber. Okay, so the value of the subscriber, how much would they pay for the lifetime? In order to do that, you need to be familiar with two other concepts. One is the average revenue per user, which is how much money do you get per user, okay? And that one will grow with time. I mean, the good things about FUBO is that they will grow with time because probably if the MAU will increase, the advertisement revenue will increase, and if they do join, as they say they would, the betting side of it, that could dramatically increase, obviously, the average revenue per user. And another thing that you need to consider, which is something that they look a lot in the private equity world, and is one of the metrics that private equity use a lot to assess how disruptive is a business and how successful could be a company, is the customer churn rate. That actually what really tells you if a company has a moat, okay? Because what's the customer churn rate? Well, the customer churn rate is how much, how strong is the company able to retain a client? So the churn rate is how many people would abandon, will leave, the company, and that's important. If we go eventually in the Brit evaluation, we're gonna show a mathematical formula for which we're gonna calculate the customer life value by assessing actually the not only the average revenue per user, but in particular the customer churn rate. So how many clients will leave the company within a specific time frame, because that one and the customer churn is very important, because if you have a high switching cost, or if you have a high barrier of entry, or if you have a very good brand and you are able to you have client captiveness. If you actually can you can actually conquest your client, you can actually retain your client. Okay, that when it means you're going to be probably successful. Now, this is the issue I do have with FUBO. Is the issue because I think you can have a nice app, you can have a beautiful app, and you can have easy way to go into a looking sport. But however, you can have competitions, and competition can be about prices, and there is nothing special about having at least what we investigated. There's nothing special about having a right to actually broadcast a particular sport. So somebody can come in with money and probably if they see a fat margin industry come in and compete with that. So we still need to understand what could be the potential moat of FUBO, and that would be the difference between try to understand if you're gonna get into the stock just for a simple growth for a sort of momentum run, or if we're gonna actually marry the stock for a long time. But actually rather than going too deep into the formula that can scare you guys, I'm gonna pass the word to Santiago, which analyzed in details through a methodology, through a framework, you know, what could be the price of FUBO. And actually what it did, it sort of like used the model I was talking about, you know, calculating the cash flow of the user, okay, and try to adjust that for the you know, for an outdoor rate. So Santiago, please go ahead, and sorry to have kept you so long.
Yes, well, thank you for inviting me. It's a great pleasure to share my view with all of you, and I hope it is both useful and of interest to you. Well, as you guys have said before, so valuing such a company with let's say a value investing approach, it is meaningless. So it doesn't make any sense. Over the last let's say 20 years since Amazon started a business made of users, so we have basically revised and changed over time our metrics. So now clearly there's one concept which should be very clear. So it is extremely difficult to model such companies, and even if you build up a very detailed model and a very complicated one, at the end of the day you will fail to capture the reality, because it is extremely difficult. So at the end of the day, we should look at the big picture, and to assess whether this business is going to create value over the long run. We should look at how users are expected to grow on a quarterly basis if you are a Wall Street analyst. On a yearly basis if you are an investor focused on the long run. So in this model, what we have made very simple assumptions, and so this model is relies on a few key figures. So number one is how users will grow up over the next 9-10 years. So we have assumed a 15% compound annual growth rate, which is higher, which is low. I mean, we believe this is sustainable. Probably at the beginning will be 50, and then will slow down to 30, and then will stabilize at a certain level. So we believe this is a sustainable compound annual growth rate for the time being. Then we have basically plugged in a 3% inflation in the subscription price. Probably, I mean, we know that inflation is a non-linear function, in the sense that probably over 2 to 3 years period, basically this company try to increase prices, in some cases to lower their churn. They can make a discount policy. So this, again, this is an assumption. We believe it is sustainable. And then there is the key assumption, to which extent the revenues is converted into a EBITDA. Given the nature of the business, we believe that 70% is EBITDA, output to EBITDA conversion is fair enough. So probably, again, this is a way to simplify reality, because at the beginning it might be 20. So now for the time being it's negative. So tomorrow might be 30. The day after tomorrow might be 40, and then going up, even up to 80%. So again, we have simplified reality. The last parameter is basically to which extent EBITDA is converted into free cash flow. So we have seen, let's say, subscription models which rely also on 80 or 90% free cash flow conversion, and this clearly depends on advertising revenues, because each dollar, euro, whatever it is, additional basically goes straight to the EBITDA margin. So if they scale up and as my friends said before, so they are able to catch up advertising revenues to a far higher extent than now, clearly those free cash flow will be even higher. So 70%, is it reasonable? We believe it is. What about other companies? Some that can rely at around 60, others at around 80. So probably that depends also on the revenue mix, on the ability of management. We will see. This is a very young company, so we will see. We believe 70 is reasonable for the time being. And then we have discounted these cash flows to the present, this free cash flow to the present, to calculate the equity value. Which is the discount rate? Well, 12%. Is it fair enough? Well, probably there are a number of risks we are taking into account. So we have not gone through a capital asset pricing model to assess the cost of equity for the company through a beta, because it doesn't make sense, simply because we have no history, we have no correlation to the market. So let's make things easier, and eventually let's rely on a sensitivity to see how the share price changes according to the discount rate and the perpetual growth rate. So we have done this sensitivity, and assuming a discount rate between 10 and 13%, and the discount and the perpetual growth rate between 1.8 and 2.6%, we believe this company is fairly valid in a range between 60 and around 73 dollars per share. So if we should guess a value right now, we would rather say at around 60. Then clearly depends also on who does the valuation, because clearly if this valuation has to be done by a competitor who is going to acquire this company, clearly there will be a premium for potential synergies. Once we look at this company as an investor, we are always looking as a minority shareholder. So we should keep this very present in mind. So the stock market valuation are always minority valuations. So is it FUBO target? Well, not for the time being, because they are still in a stage where there is uncertainty on the fact that they will reach a critical mass which will guarantee the company to survive over the long run. We believe they have all the cards to play to be successful in the market and to be eventually either a potential target in the future or a company who is going to aggregate other players, especially probably in the gaming arena, because I mean, if we look at the competitive edge of this industry, we also believe that it's going to be reshaped in the coming future. So probably they will abandon eventually some sources of revenues, and they will rely on the new sources of revenues. So who knows? For the time being, we believe this company is well managed.
So
they have a great. Yes, please.
Oh, sorry. There could be then, you think, maybe acquired just also to avoid competition. For example, a company like DraftKings, which is a big company now, much bigger, could probably acquire them to avoid that a company in a different segment in the broadcasting rather than just gaming like DraftKings is, could eventually buy just to avoid competition. Could there be something, or maybe just to get a boost from the synergy of the two businesses together? Could that be?
Well, this is let's say this is a sector which becomes to be crowded. So some of these competitors will be eliminated, and some others will be acquired or will acquire. So it depends on whether there's any synergies in doing the acquisition, because if the management believes that acquiring a company just generates overlaps, it doesn't make sense. But I believe in the future it might be a potential aggregator or a potential target. Depends. Depends on a number of factors which clearly we cannot assess at the moment. But this is a potential upside also for minority investors like us.
So recapping, all the spreadsheet, basically you've been really conservative because you used a year-to-year growth which is net of the churn rate. So it would be only the net, considering already basically the net growth, the one already considering a churn rate possible, and that one, if you level that 15%, it's quite after 2022, it's quite reasonable, probably very conservative. And then you kept the subscription price low, even if it did at $60-65 level, probably you would expect a higher level, but probably you kept it low because of the competition, because you don't know if somebody would actually hurt the so keep price low, considering competition will kick in and eventually try to steal clients at a lower price. So that makes sense. And
absolutely.
Then and then the EBITDA per ARPU, you basically use also a number which is very conservative. What I noticed, and I want to make sure that we all understand, is that basically you're not too much concerned about debt or enterprise value, because you are already targeting free cash flow. So the free cash flow has already the debt which has already been served. So at that point, be net of the debt, whatever. If you look at the free cash flow, whatever debt is there does not really mean anything, because otherwise they would be already into the free cash flow number.
Correct. So that's a free cash flow. Debt holders have already been served.
Right. So basically, what the equity value, the market cap that you actually forecast is around $5 billion, $65. And
in the range of, yes, in the range of.
Okay.
Clearly, you said I was conservative. I think probably the right approach is, instead of let's say trying to figure out the right users growth, let's say what the market is discounting right now. So so the stock is trading at $27 per share as today. So what is the users growth and the order rate and the G and the free cash flow conversion this company is discounting right now? Probably this company is discounting a year-on-year growth in users, which is single digit, probably high single digit. But this is not a company expected to grow low single digit.
Can I ask you a question? I think then the time will be probably finished. But why there is such a difference between a price to sales valuation and an equity value based on the sensitivity analysis that we did? For example, if we look at how the market usually look at price to sales, and now the price to sales is 4, and the 4, we have 5 billion, 5 billion 0.8. Now 5 billion is the market cap, right? But then we did based on the price sales in 2030. So we need to bring it back to the value of today. And if you bring it back with a rate of 12%, it's not even that conservative, because we think that the WACC at the moment is 20%, 22%, 12% is probably just a reasonable number, considering that the equity value of the beta of this kind of company are really, really high, and the equity value of the company, it's high, is only 2 billion. So why there is such a difference between the 5 billion, the 2 billion of something based on the present value of a price to sales by looking at 2030, and the equity value that we calculate with the sensitivity analysis. What could be what it depends for?
Well, because I mean, when you look at the price to sale ratio, clearly you are assuming that sales is a value driver, and that's correct, because users and thus revenues are the real value driver. So this is not a business made of margin. This is a business made of sales or subscription or revenues. So probably, I mean, the market, fundamentals are reflected into multiples. So the approach is pretty similar. Basically, and the time horizon is also very similar. Probably there's a difference, because we are looking, when we go through a free cash flow to conversion. So basically, we are going deeper into the valuation, and looking at which is the value left for shareholders from those sales. So basically, this is not captured by price to sales. So price to sales is normally very high, even 20 times, which seems basically something astonishing, because we were used to value 20 times earnings and company in traditional old economy, in traditional sectors like oil or wherever. So it seems astonishing, but probably if you plug in 20, you get, or something in something very similar to, you get a valuation which is in the region of 60. So now again, the question we should ask ourselves is that multiple correct? Clearly, we don't know now. What we can assess for this company is how they're running the business, what is the value driver, and then basically, I don't want to say betting, because investing is never betting, but to a certain extent you have to suppose the management view that those users are going to grow up faster and faster, and so that price to sales which now seems to be astonishing, over time will go down.
Okay, so would you feel comfortable with saying that maybe those $65 that comes from the spreadsheet need to be probably adjusted for less growth in case of competition kick in and there's no moat, and also for an eventual dilution?
Yes, absolutely, yes. What we can say for the time being is that this is a company which has a great potential. They are in a great business. They are doing the right moves. And if things go as we are imagining, there is also a great value creation ahead. This is what we can say at the moment. What we can advise so investors is probably depending on their risk profile, but this is a company to keep a beady eye on if they're looking for a growth story.
Okay, so that what I think, the way I view it is probably is an amazing growth story. Has got tremendous momentum. It's a company that can, the more you get to know more, the multiple seems to be eventually, really a discount. However, it can be very risky in case a lot of other player comes in the market. There is a dance that we saw that could come with an IPO next year, and
absolutely,
it's owned by a big guy, a big company, and could potentially steal market. And also, there is a fact that probably after it's probably not that story that unless the equity story does not change, unless something more innovative comes in, and maybe there is a synergy with another company for betting. If a story doesn't really change, it's not that kind of story that you need to keep forever. It's something that you let you grow. Eventually, when you meet the target price, you sell it. So it's not something that you keep like Amazon, like Google. It's not that kind of story, unless, of course, unless of course something happened that changed the equity story. Would you agree with that? So it's more like
yes, I definitely agree with you. I mean, this is not a franchise story that you I mean, this is not the company you are buying for your retirement portfolio. There's a great potential again. Clearly, when you buy such stories, you know that volatility is the rule of the game. So especially if they miss a quarter of growth or whatever, probably the stock is going to lose 20% in a single day. Or if they match or go ahead of consensus, probably they will go up 20 or 30%. So you have to, I mean, this is not a story for all investors. You have to rely on a strong stomach to hold a company like FUBO.
Yeah. And then probably we're going to suggest eventually to the one that they missed it, to probably sell some put, trying to probably take advantage of the volatility of the stock and eventually get in at a lower price. You know, because this company, after it reached the 2.53 billion market cap, it started to be expensive, you know, because unless of course a catalyst does not come. So guys, thank you very much. It was amazing, and we're gonna see everybody for the next stock and next story, and or eventually if you get a lot of interest on this stock, we might do a
follow-up
live session for questions to investors interested in more information.
Thank you, guys. It was a great pleasure sharing my view with you, all of you guys.
Thank you, guys. Absolutely.